We ready to go? Yeah. Well, first of all, I want to thank you all for joining us today for the webcast. SPACs, Special Purpose Acquisition Companies, remain a financing source for life science and technology companies, presented by the Pittsburgh Venture Capital Association. I'm Eric Kline. I am a director of the PVCA. I'm an attorney with Troutman Pepper, and we've worked with several SPACs over the last few years. And so we'd like to take some time this morning to tell you a little bit about how they operate and more about SPACs so that you can do a deeper dive yourself. Before we begin the program, I would first like to thank all of our PVCA annual sponsors. The PVCA would not be here without their generosity and support. Programs like these are only possible because of the sponsors. If you're interested in becoming a sponsor, please contact Micah Whitfield, the PVCA's Director of Business Development. There's a free membership for an individual under the age of 40 that comes with your sponsorship, and complimentary attendance to all regular virtual events for sponsors and anyone at their organization. Moving on to today's program, I'm honored to introduce two of our presenters, our two other speakers today, Michael Butler, Chairman and CEO of Cascadia Capital LLC and Chairman of the Board of Cascadia Capital Acquisition Corporation, and Dr. Lynn Kirkpatrick, CEO of Ensysce Biosciences Incorporated. If you have any questions for our panel during this event, please use the Zoom Q&A function, and we'll do our best to respond during the program. So as we move forward, then I'll have each of our speakers introduce themselves further. But let me first sort of put what we're going to try to do today into some context. There's a lot of noise about SPACs that's going on. A lot of it is in the news today. As a matter of fact, from today's Wall Street Journal, you won't be able to read the article, but there was actually an article about one that's being done by Donald Trump, who's merging an entertainment company, his entertainment company, with a SPAC. And they, so one of the things we thought we would do is talk a little bit about what's just going on in the market today and so on. And what I thought I would do is just put it into some context first, because what I found is that in this area, there's a lot of confusion about the definitions of the various parties involved with SPACs. And so before we go too far into the program and just launch into a story about a SPAC itself, and Mike will provide us with background about the present market for it, I just wanted to put it into some context. So a SPAC itself, it's a listed company, so a public company with no assets that attracts funding from investors in anticipation that it will buy potentially valuable assets from another company. So what does that mean? It starts with a sponsor of the SPAC. The sponsor is the initial financial backer. So the sponsor actually puts money into the SPAC with a view towards taking it public, doing an IPO for the SPAC itself. Now, the SPAC at this point doesn't have an acquisition target yet. What the sponsor does is he's filing an IPO prospectus to take the SPAC itself public and then go and look for the acquisition target. So the sponsor puts in several $1 million, and in exchange for that, that sponsor gets a big slice of the IPO that results. After the initial SPAC goes public, which takes just a few months, and the filing itself is pretty formulaic, they all pretty much look the same, then the company closes the IPO by bringing in the initial investors. So these are the parties that fund the SPAC itself. Again, the SPAC at this point doesn't have an acquisition target. So these people are putting money in saying, hey, we like this sponsor, we like the story that he or she is telling us about what they think they can do with a SPAC. So we're going to put our money to work here and see what the sponsor produces. Now, here's something that's really important about SPACs. Those initial investors, and they're usually hedge funds, they have something called a redemption right. And what that means is that if they don't like the deal that the sponsor brings back, they don't have to do that deal because all the money is being held in a trust, and that trust can't release the funds until that acquisition occurs. So if they don't like the deal, they can get their money back. So there's another kicker for those early investors, and that is that each of them typically receives both common stock and a warrant to purchase shares. Even if they choose to redeem later on, they don't have to give back the warrant. So it's kind of a no-lose proposition where if they like the deal, they can leave their money to work into the deal, but even if they take it out, they still get to keep that warrant. And we'll talk about that more as the program sort of progresses. I mentioned that the money goes into a trust, and the trust holds those funds, and they can't be taken out for any purpose until that final acquisition occurs. And at that point in time, the early investors who want to redeem out can redeem out, and the rest of the money rolls into the SPAC itself. That SPAC then merges into a target company. And today, a company that has gone through that process, Ensysce Biosciences, is going to tell you a little bit about the process that they went through. But at the end of it, the SPAC merges with the target company. The target company sort of survives. That's the company you would know. And then the cash that remains in the SPAC is used by the target company. So there's something else that happens during the SPAC process, and that is that they often raise additional funds through something that's called a PIPE, which is a private investment in public equity. And so what happens is that the SPAC itself may end up at the end of the process not having enough working capital to actually fund that target company. So during the process, before the company does what's called a de-SPAC, before that target company goes public itself, they may raise additional funds by means of this private investment in public equity. So that's kind of the background on some of the terminology. People might question, is this something that's completely new? I mean, did this exist before and so on? Well, it goes back quite a bit, but when I worked at the SEC 30 plus years ago, they had SPACs, but they called them something different. They called them blank check companies. And there were different things in the rules then, which kind of made them highly skeptical, the SEC highly skeptical of these. So those blank check companies worked a lot like the SPACs do today, but they had two significant differences. The first is you couldn't get your money back. So if you wanted to invest in what was called a blank check company, you put your money in, you put your trust in the sponsor went out and bought another company, and then that's what you owned. So you didn't really get that choice. And the other big difference was no one at that time, or generally speaking at that time, you may have gotten a share with a warrant, but you didn't get to keep a warrant if you withdrew your money, which you couldn't do. So what happened in this latest sort of the events of the SPACs that are going on today is the existence of the warrant, which allows an early investor to take its money back, but still keep the warrant, makes the investment very attractive. Again, if they want to continue to participate, they leave their money in, the trust releases all the funds, and the acquisition goes forward in that way. But if they don't, they still get to keep that warrant. So the rules sort of changed over time. Those rule changes and market changes actually resulted in the phenomena of the SPACs that we see today. If I could, at this point in time, I want to reintroduce Michael, who's going to tell us about the present market dynamics and what's going on in the market today.
Sure. Thank you, Eric. So I'm Michael Butler, CEO of Cascadia Capital and chairman of the Cascadia Acquisition Corporation. So a little background about how we came about sponsoring a SPAC. We do a lot of late stage capital raising for private companies. So think $75 million to $200 million rounds of minority equity capital, pre-public rounds. And earlier this year, we were raising capital for a couple of companies, and ourselves and our clients were approached by SPACs. And our clients were very intrigued by the SPAC product. They thought they could get public, it'd be a premium to the private markets. But the SPAC sponsors were two guys who met 2 months ago working out of a WeWork. And our client said to us, I like the product, but I'm not sure that I want to hitch my wagon to these particular sponsors. And one thing led to another, and a couple of our clients say, Cascadia, have you considered a SPAC? So it just so happens, like Eric, I have a long history on Wall Street, and I'm dating myself. But one of the people in my wedding, my best man, was a gentleman who was one of the creators of the SPAC product at Early Bird Capital in the early 1990s. So I called him up and he said, you should talk to Cantor Fitzgerald. I'm an advisor to them. They're a top 3 underwriter. So we started the discussions with them about, why do a SPAC, and, does it make sense? And we thought it did. We thought it was a great product to offer our client base. Kline thought that we had a competitive advantage because we have so much deal flow. We'll do 50, 60 M&A transactions this year and financing transactions. They thought it made a lot of sense for us to become what they call a serial SPAC sponsor, much like Moelis in the $3 to $4 billion company category. So we worked hard. We prepared the paperwork, and the market fell apart, as you probably all know. What happened, and I've seen this with many products, Wall Street overshoots, right? Wall Street takes a good thing and makes it a bad thing by raising too much capital or overshooting the market. And what happened was, a lot of SPAC sponsors were quality, and they got out into the market. So you have a lot of SPACs out there with sponsors that, are not probably the right people to be managing those SPACs. So the market went through a digestion period in March, April, May, June, July. And then there were a few green shoots in August. And our underwriter called us up and said, meetings tomorrow. Be ready to go tomorrow. The market's open. And so we met with 16 investors over Zoom, and 12 of them invested in our SPAC, and they own probably 90% of the public float. What was interesting is, we thought we had a good story, and the investors were like, God, this is a great story. This is wonderful. You and Jamie, who's the CEO, my partner in Cascadia, have worked together 18 years. You got a firm of 85 employees backing you. This is fantastic. We were like, well, it's good, but we don't think it's that great. And they're like, oh no, this is great. And you should see some of the SPAC teams we've met. They walked through, a few examples, and it was pretty startling to see the quality of sponsors in the market. There's an old Wall Street saying, in the land of the blind, the one-eyed man is king. And we're definitely in the land of the blind, and I think we had one eye. But what's happened since is the market is going through a period of ascertaining quality, right? So the SPAC sponsors that are quality are able to get out and get public. And the market is really taking a hard look at what de-SPAC candidates, what merger candidates SPACs come up with, and really going through a deep diligence process to ensure that those target merger companies are public company ready. Up until probably March of this year, investors just invested and they figured they would trade out after the stock went up. As some of the SPACs have traded down, the investors are really looking at fundamental research and fundamental diligence to determine who the right companies are to be public. And so what's happened is a lot of SPACs have presented merger candidates to the marketplace in the form of a PIPE transaction, and investors have voted thumbs down and not funded them. And that's why you have so many SPACs out there searching for de-SPAC candidates. In talking to the institutional investor community, they believe the market is in the 4th or 5th inning of working through this indigestion in terms of trying to figure out who are the quality sponsors and who are the quality SPACs and who are the non-quality SPACs in the marketplace. The view seems to be that the IPO market will stabilize or enter equilibrium in the beginning of next year, so first quarter 2022. Equilibrium to them means that the good SPACs start trading at $10 or more a share, which is the issue price. And then they view the PIPE market, which is kind of the validation on the back end of the process will stabilize sometime in late Q2, Q3 of next year. So again, this is not unusual. Markets do react, and you're seeing some changing of the SPAC terms. It used to be that the sponsors, could make 20 times their money. I think that's now down to 10 plus times. It had been that sponsors had 24 months to find a de-SPAC candidate. That's down to 12 to 18. So the market is definitely adjusting. It just takes time, but I think all this indigestion is long-term positive. Obviously, it's short-term negative, but it's a necessary process so that the SPAC market comes out the other end in a much more healthy position.
Well, that's great. So we'll be back to Michael a little bit later on some, thoughts on the SPAC market as we roll forward. Next, I want to reintroduce Dr. Lynn Kirkpatrick. We worked with Lynn's company as she went through the SPAC and de-SPAC process. Ensysce is a great company, really trying to do a mission that would really be something really important for people. Lynn's going to tell you a little bit more about that, but it was one of the nice things I'm working with the Ensysce Biosciences IPO, if you will, is that what they're trying to do is a very big ticket, and it would have a very profound effect on society. So with that, I'm going to turn it back to Lynn and to tell her story.
Thanks, Eric. And yes, it has been nice to work with you for the last, I would say, 9 months. I'm, as Eric said, Lynn Kirkpatrick. I'm CEO of Ensysce Biosciences. My background, I'm a medicinal chemist, pharmacologist, drug developer, taken a number of drugs to into the clinic, have worked with a number of companies, and these companies, the first one I founded actually went public through a merger with a public company. I started working with Ensysce a number of years ago. We have technologies, and I'll give you a little background just because as you look at companies, merging with a SPAC is one way of obviously going public, but obviously companies need to finance themselves. And really our path to this SPAC merger was both because of our technology and our path for fundraising, not really a planned path, but it's the path we ended up with. As Eric mentioned, we do have compelling technology. We have what we're calling the next generation of opioid products, products that are chemically modified to reduce abuse and provide overdose protection. We've proven the technology in our clinical trials. The technology works. We have fast track status with our lead product, and we're looking to replace OxyContin in the marketplace. Obviously, working with opioids in the private arena was challenging over the last few years based on the litigation, the politicization of the topics, and we felt moving to the public market in one way or another was a way to provide the funds we needed to rapidly get this technology approved and commercialized. We looked at many options, reverse mergers. We put together a financing or a financial backing that would provide funds once we moved into the public arena. So we started looking at various opportunities, including at the very end of the year, looking at SPACs. And Eric and Michael have both talked about the SPAC. A SPAC is set up. It has money in it. There's a number of items to think about. One, the sponsor. Two, is it a new SPAC? As Michael indicated, these do have a limited lifespan. Redemption potential, even if a SPAC is 100 million or 200 million, by the time you actually close and de-SPAC, a lot of that money is redeemed. So early in January, we were introduced with a group. The sponsors, as Michael said, which are important, had done this process before. They had formed 3 prior SPACs, had been very successful in doing it. And this particular SPAC they were holding on to was their 4th. It had been established in 2017, which, based on the fact that we were talking to them in 2021, they were what's considered an end-of-life SPAC. They had a lifespan that they had to find a target or lose their public listing. They had identified a target pre-2020, a Canadian casino company, just prior to the pandemic when the Canadians closed all their casinos and that deal fell apart. So they were looking for a target. We were looking for a SPAC, and it really was, I would say, a marriage made in heaven. Now, originally it was a $200 million SPAC, but after their casino deal fell apart, majority of their investors had redeemed. So we were going into this with eyes wide open, understanding the money available was there and anticipating that we would not lose the majority of funds that were left in the SPAC. They also had a very short timeline because of the fact that they were now over 3 years from their founding. They were required to identify a target, get to definitive docs, and to closing in a very rapid fashion. So they were motivated, we were motivated, and the sponsors of this SPAC were also what I felt very quality individuals. They were connected in the industry. We met, we felt like we connected. They liked our technology, understood the potential, even though they were a leisure acquisition corp, more in the gaming industry. Our technology provided them an opportunity to have a very positive technology, although not quite in the arena that they had selected. So as I mentioned, the lifespan of the SPAC is important. The redemption, understanding that redemption, and investors redeem as well as get interest on the money. So they really have a win-win situation. And the end of life quality possibility, obviously with us, it gave us, they were motivated, we were motivated, and we were able to move across the goal line. The activity, and I can talk about kind of the pros and cons. Obviously, we had a limited timeline to get all of the legal documents put together. We were moving from being a private company into the public arena. We had not developed a private placement memorandum. So we started the documentation from scratch, end of January, writing all the documents. We were required to get the S4 filed very quickly. We also had to have all of our financials audited and get our company into public ready position. And over the period of time, obviously understanding the financial situation, the costs involved in doing this, we also did look into the pipe markets and put together or went out to talk to banks and do the activity to put together a potential pipe. Pre-de-SPACing, we successfully did our financing post-de-SPACing, but over the period of time that we were doing the legal documents, we were also talking to banks and everything else. Now, the difference between a SPAC and doing an IPO is that I believe a company gets much higher visibility if you are doing a proper IPO then merging into a SPAC where you potentially don't have your banker support, your banker visibility, and those investors that are anchor in a particular deal. What you have are the individuals who could redeem their funds when you actually close your deal. Fortunately, we had very little, in fact, a minuscule amount redeemed at the end, and we were successfully able to get across the line, realize the revenue that was, or the cash that was still in the SPAC, and successfully close a financing after that now allows us to execute our clinical plan. I believe at the time we looked at the SPAC, we were a public ready company. We have a clinical program. We have fast track status, as I mentioned, on our program, a vast intellectual property portfolio. We had worked for years to identify clinical candidates and build this into a clinical pipeline that can be commercialized relatively readily, where we'll have revenue driving the company. I have talked to a number of individuals who have looked at using SPACs for financing that were at much earlier stages. And I do believe the target company, especially in the biotech industry, does need to be a quality company that can handle moving into the public markets, private markets, and certainly understand what they're getting into when they are looking at the SPAC process. Again, I'll just reiterate a few things that both Eric and Michael have mentioned. The sponsor is very important. You do get tied at the hip with these groups because they become investors in your company, and their investors also have to understand your technology because you want them to stick with you when you do the SPAC. Besides the company we merged with, or the SPAC we merged with, we had talked to other groups, and these were newly developed SPACs who do have that luxury of looking around at multiple technologies to select their targets. So in our case, when we were introduced to Leisure Acquisition Corp, we were both highly motivated, and that was part of our success in making this a successful de-SPACing, partially based on the fact that they were end of life, and we, over a very short period of time, were able to get them very comfortable with our technology. I think another piece that companies have to be aware of once they do move into the public markets through the de-SPACing is the investor relations, because of just the different process from a traditional IPO where you might not have that solid investor base. It's very important to position yourself both with PR and IR in the days of the de-SPACing, so that when you are public, then you're prepared to be able to make sure you have good visibility in the public market. I think, Eric, that's it for me for now, and we're certainly happy to discuss and have questions later on.
Okay, well, we're not going to let you off the hook yet, Lynn. I had a couple questions for you. The one is, as you went through this process, you had to develop more of a public company story, if you will. And maybe you could comment on that. And I know you worked with the sponsors on it somewhat, and you certainly had a lot of meetings. Maybe you could tell us about that.
Yeah, certainly. And as we know, in the public arena, legal is very important. So we work closely with Troutman too to make sure that our public story fit into how one would describe a public company versus how you act in the private space. Certainly we developed not only the scientific story, but the financial story, and made sure our documentation, anything that we were providing to the public, was made in a fashion that was acceptable from the financial, the SEC filing, but also in the legal sense. So certainly you describe all of the pros, but also all of the potential risk factors that people need to be aware of. Make sure your documentation is vetted in a legal and financial set, but also set it up so people understand not only the technology, but the financial story behind the company.
Yeah, in that regard, there's a lot of parties involved. On our end, we had intellectual property lawyers. Your initial contact was through Ray Miller, who's an IP lawyer here, who assisted because it's a very complex part of the IPO registration, the SPAC registration, to actually explain the technology. And of course, you have legal liability on it, so you want to be completely correct. One other question for you is, what about building out the team? So you're going from a private company to a public company. There's some different things that you need. What did you do? And I don't know, what are your learnings from that?
Well, certainly, as Eric knows, we're a very lean team. We have technology in the clinical space. We aren't an R&D company per se at the moment. So it's not that we had individuals and a large group of research individuals, but we had executives on the team who had experience both in drug development, drug commercialization. The biggest aspect, and what I found myself in the middle of, was my CFO resigned prior to us moving into the merger with the SPAC. I had put together an interim team to facilitate managing the financial aspect of the company, but also felt it was very important to get an individual in the financial role because of all the filings who understood both transitioning companies from private to public, but also certainly filing on the public. So that was a very key position that fortunately, because the area that we have the company in San Diego, we have, I think, over 1,000 biotech companies, highly experienced management, and I had a pool of individuals to choose from. But if you're a company that doesn't have that luxury, certainly the CFO is a key position, and the finance team. As Eric mentioned, I had worked with intellectual property lawyers at Troutman prior to working with Eric. So our intellectual property portfolio, both on the side that the Troutman team worked on, but also another group in San Francisco, I knew that was solid, and they have worked with the company. And I kind of feel like our legal team is built from the relationship that we have with these two companies, and certainly other aspects of building out your management is understanding that your team needs to have some experience in the public arena. So
turning, Michael, I know you jumped on. We had a question. I don't know if you were going to address that or you saw that chat question, but the question was essentially, why doesn't everyone just redeem out and keep their warrant? Why continue to play along when you get the free warrant? So I wonder if you could address the question. And
that's a great question, and that is one of the challenges in today's market, as the SPACs, when they go public, have been trading down. In that instance, it absolutely makes sense to redeem and keep the warrant. However, prior to March, prior to this indigestion in the market, SPACs were trading up, right? They were trading from $10 to $12, $13, $14, $15, $20, $30 in some cases. So it really depends on whether when the SPAC goes public, it trades up or trades down. If it's going to trade down, obviously there's an incentive to redeem. If it's going to trade up, you want to stay in and ride the upside of the merger.
Great. So I was going to turn back to follow up on a couple of the things that both you and Lynn raised. First of all, in terms of what makes a good sponsor, and you both kind of commented on it, but so what we saw or what we're seeing is that you want someone that's got good domain expertise as they look at making an acquisition in a space, a sponsor that has access to these pipe investors or just relationships where they can pull on that additional money. But there's one other thing that's really important, and that is that ultimately you're seeking longer term investors in your company. So you really want one, if you can get it, that's got some good institutional relationships, because you don't want people to just buy and sell your stock. You actually want a core group of institutional investors to hold it. And unlike an IPO, where you get those kind of relationships, hopefully along the way, you don't get them with the SPAC. So when you come out, you don't really have coverage per se. So you're looking for someone that brings that to the table. And maybe Michael, maybe you could comment on some of those points about what makes a good sponsor.
Sure. Yeah, we thought long and hard about the qualities that make a good sponsor prior to deciding to sponsor a SPAC. And in addition to everything you mentioned, Eric, I think alignment and partnership is extremely important, right? We don't view our negotiation as sponsors with a SPAC candidate as a win-lose or either or type of negotiation. We view it as a partnership and a long-term partnership. So together, we determine the value of the company. Together, we determine the structure of the transaction. Together, we determine the target investors in the company. Together, we determine what's the ideal board, right? Because as a SPAC sponsor, we're thinking long-term. We're thinking a partnership with the company, not as a trade, but rather as a long-term investment. And I think that alignment and partnership mentality is extremely important. And in addition to the things you mentioned, I think the domain expertise is incredibly important, right? I think that as a SPAC sponsor, you really need to understand the industry, the subsector, and be able to do not only the appropriate diligence, but help that company going forward once it's public. So with our SPAC, we have three investors or three board members on our SPAC. One is an entrepreneur. He's founded and started many, many companies. He's been backed by investors such as Apollo. So a very, very experienced operator. The second board member is an individual who's been an investor. Edgar Lee was the third member of Oaktree in the early days, right? He ran many of Oaktree's funds. Oaktree is one of the largest private equity investors in the country. Edgar's been doing it for 20 years. He brings that investor mindset, that investor lens. He's also got very, very deep relationship with investors in the public markets. And then the third member of our board of directors on our SPAC is Arun Venkatakari, who's a Pittsburgh native, the senior executive at Aurora. He understands robotics, autonomy, AI, right? We were recently meeting with a potential SPAC candidate. He spent 4 hours with them walking through their technology stack and was able to point out the good aspects as well as some of the deficiencies that they're going to need to fix before they're public company ready. So I think that bringing a group of people together in the form of a SPAC sponsor that can add value to the companies is incredibly important, and what helps delineate the high quality SPACs from the lower quality SPACs.
Great. So one of the other things that I wanted to talk about briefly, and I'll have Lynn comment on this too, is just the considerations that a target company might have before undertaking a SPAC. And one of those things would be you'd look at the spectrum and say, could I do a venture capital deal? Should I do a direct, initial public offering kind of deal? And when you look across the spectrum, so on a SPAC, theoretically, you'll get a higher valuation because it is a public company with public investors, but it takes a lot of time and it's a very expensive process. If you did a venture capital deal, it could be quicker, cheaper, certainly. And, again, if you did an IPO, you wouldn't have to pay the sponsors what they make. You wouldn't have to give out the warrants per se. I mean, again, they're all different kind of things. Maybe just talk about your experience a little bit, Lynn. I know, again, the company didn't just start. I mean, it's been around for actually a while. It did a merger 5-6 years ago, which was important to the technology that it has. Maybe just your process in going through that, and also what the SPAC is ultimately, how that has helped you in your funding strategy after the SPAC, after the de-SPAC transaction.
Sure, certainly in the biotech world, obviously in the private arena, when you're developing your technology, you are looking for venture capital support. Ensysce actually started a number of years ago, and I was with it when it founded, and it had a technology which was, I would say, avant-garde. We were using carbon nanotube for delivery technology, way beyond before its time, although it'd be very useful right now to help stabilize some of these vaccines. At the time, we were looking at it, developing cancer delivery opportunities. And Eric mentioned we struggled to finance, and we were introduced to another company that was struggling to finance with the current opioid technology. And part of that was the climate in the opioid space. So because we had two delivery technologies, the founders of the companies met, merged, decided it made sense to merge. So we acquired our technology in end of 2015, I guess, beginning of 2016. I continued on as CEO of the merged company and moved to develop the technology, but also to finance the company. And it was the climate. We met with individuals. Opioids were not high. So doing a venture capital financing, we found challenging. We did, as I mentioned, put together more of an equity line of credit financing that would back us once we were public. And moving into that public arena, we considered a reverse merger. Obviously looked at SPACs and also talked about the IPO. I think individuals think it is longer doing an IPO than potentially doing a SPAC merger. We ended up with the SPAC opportunity after exploring maybe doing a small IPO just based on our market cap and various ideas, but you also have to have a banker that will step up to the plate to actually lead an IPO. And we found the SPAC opportunity, I think, at the time when we were weighing the two different arenas, we found that doing a SPAC or de-SPACing from a SPAC merger is very labor intensive, very expensive. I don't think you save money doing a SPAC, and the potential for redemption, which is generally when just before you de-SPAC, is always there. And that's why most companies will put together a pipe financing at the same time they're de-SPACing, because is no guarantee that the money that was initially invested in a SPAC is actually going to stay there. And as I said, most of that redemption for our particular SPAC had already happened. So that was one thing taken off the table. But our thought process was all of those avenues, and we ended up mainly, I think, based on the opportunity that was presented to us, choosing the SPAC route.
Yep. Well, let's move into the final part of the program here, and that is just the future of SPACs. And I would make a couple of comments before I turn it back to Michael. One is that, you know, SPACs are also different from a disclosure perspective, because in the SPAC prospectus, when you make the acquisition, so this is sort of the part where the SPAC company has raised the money, now it's going out, it finds the target, and now it's going through that process of de-SPACing. What you're allowed to put into that IPO prospectus are projections of future performance, which is very unlike an IPO where you basically never do that. And so one of the things that's happened is that at times, well, just like in any other thing, the projections end up being wrong, and probably in most instances they will end up being wrong, you know, one way or the other. But that is one thing that's significantly different. And then a couple of companies have already been caught with projections that maybe were a little too glowing, so they had to backtrack a little bit. That gave a little bit of a black eye to the market, but it is something that's important to investors and something that you typically don't see in a public company. And so, you know, in my view, you know, the SPACs remain a viable mechanism because you can get good sponsors. You do raise a reasonable amount of money. And these are companies that might not otherwise be able to do an IPO. So you are getting in a little bit earlier, let's say, than you might in an IPO, giving ordinary people the ability to participate if they choose to. And again, with a lot of disclosure, because it is full disclosure. It's the full thing you would see in an IPO prospectus that you have to see in a SPAC prospectus as well. With that, I'm going to turn it back to Michael and let him address, you know, what he sees as how things rolling forward, and any other comments that he's got. And we'll look at some other questions if we've had any.
Yeah, Eric, I would agree. I think SPACs are here to stay. I think there will be refinements in the SPAC structure and around the economics of the SPAC. I think if you believe we are in Industry 4.0, a transformation of our economy to the merging of digital, biological, and physical, there's going to be huge advances in technology, whether it's health technology, information technology, robotics, AI. Heretofore, most of the benefits of technology transformations have been afforded to private equity and venture capital and growth equity investors, right? The funds in Silicon Valley who invest in these companies. The SPAC, as you mentioned, allows the public to be investors in these companies, where otherwise they would go to the Sequoias and the Kline Perkins of the world. So I think it opens up the technology investment opportunities for public investors. Now, it doesn't mean that every investor should invest in SPACs, but I think it does allow access, which is important. And the other thing we're hearing from companies that we're talking to who are potential SPAC merger candidates is that they feel their potential employees need public options. So what's happening is there's a war for talent for a lot of these companies that are in autonomy or technology or a very, very hot sector, and to have public currency, public options to give their employees is something that they consider to be a competitive advantage versus the other companies that are trying to recruit those same employees. So I think from a company standpoint and the access to human capital and an investor standpoint, it is a structure that does indeed make sense and kind of democratizes the access of great opportunities for the public investor.
And part of it is that there's a lot of information available about these companies by the time that they de-SPAC. Again, in a venture company that, let's say, are a friends and family round that people might go into, the amount of information you get is really limited. That's why it's been usually limited to really sophisticated people who can participate there. This does democratize things, and I think there is a place for that. Again, everything sort of swings, but to me, I think there is a place in the future for it. Yeah, I just wanted to thank both of you. I think this was really helpful. Hopefully, it gives people a much better perspective on how SPACs operate from the perspective of a sponsor, which is what Michael is doing now, and from Lynn's perspective as a company that's gone through this process. Did you guys have any other comments you wanted to make before we sort of wrap up? We good? I think we have one more question. So let me see what somebody asked here. So they're asking more about Cascadia and what you're looking for in your SPAC acquisition, the sector, the stage, the revenue, et cetera. This could be somebody that's looking to do a SPAC. So
yeah, so our SPAC is focused on robotics and AI. And Eric, what we're looking for are companies that are differentiated. Right, not the fifth Me Too company, but companies that have unique offerings. They don't need to have revenue, but they do need to have a backlog that can be diligenced and validated. I think that's incredibly important. They need to have a product that is operating, and they need to show that that product is something that has market demand, hence the backlog. But again, I think the most important thing right now is differentiation, right? Having something that is not the 10th of its kind, but maybe the first or second. And that's what the market is telling us, I think, that they're looking for companies that have something unique. And so that's our focus. Obviously Pittsburgh is a pretty fertile opportunity for us, given the robotics and AI companies in this city. So that's why I'm spending, 1 to 2 weeks a month in Pittsburgh.
Yeah, and I think that's one of the things in a different area in life sciences about Lynn's company, which really gave it that public market story, was it really does have this unique technology which is able to potentially transform that industry. And believe it or not, I think, Lynn, you correct me, opioids are still, that's what's prescribed today. It's still, there isn't a replacement for it yet.
Yeah, opioids aren't going away. There are so many health indications where you need an analgesic for severe pain. What we need in the industry is something that can reduce this crisis that we see and make people comfortable taking opioids again, making prescribers feel more comfortable. And that's why I describe ours as the next generation, because in the past, what has been developed are more Me Too, as Michael says, products similar to OxyContin. They're just a different formulation of an opioid trying to reduce an individual's ability to abuse it. What we've done is chemically modified. So we are starting this next generation. Our clinical trials have shown that the product works. The FDA has given us fast track status, so they're backing us, they understand. And with our overdose technology, we believe eventually, once we're on the market, we'll be saving lives.
Great. So with that, let me thank our audience for attending today. And a survey link will be emailed to you following the webcast. Your feedback is greatly appreciated. The next event by the PVCA will be held in person on Wednesday, November 17th at the Fairmont, where Dr. William Wagner of the McGowan Institute for Regenerative Medicine at the University of Pittsburgh will be speaking. Please stay tuned to your emails for more information. We hope that you will join us. And again, thank you for taking the time today for learning more about SPACs, and enjoy the rest of your day. Thank you. Thank you both too.
Thanks, Eric.
Yep.